Welcome back to the show. If you are just joining us, we are having a discussion of what next on the NSE. A couple of decisions have come through. We've had banks cancel dividends. That's Equity Bank cancel a 9.4 billion check that it was expected to pay. We've also had other banks say we're either going to delay this decision or we will give a bonus. Over and above that, we've had the companies coming out and saying, you know what, it's a hard year, COVID has made it a bit harder, and we are issuing cautionary statements in as far as our trading revenues and profitability is concerned. Reginald, who works with Zamara, is helping us understand then, based on what's happening, looking at the macro environment, looking at COVID, looking at the numbers that are coming through and the statements coming through from the corporate world, is now a good time to invest. The break, we had a very elaborate conversation looking at the risk-free rate and trying to understand what models you can use to evaluate the earnings generation and valuations for the securities on the exchange. Now that we've come back, I want us to get to the point of understanding. We are looking at the risk-free rate. Central Bank of Kenya is actually sitting today to take a monetary policy decision. When you're looking at the equities today, Reginald, what is an applicable required return that you're looking out for, at least for the next 2 to 3 years? Because we can't really look at this year. This year is more or less gone.
Definitely has to be there for equities and the risk that one has to take. If we take a 5-year or even the IFB as a good risk-free rate, which will give you close to 10, let's take 10%, the latest issue that they're giving. So number one, that's one return that you have to get is definitely the risk-free rate is 10%. So the next thing that you need to ask yourself, where else would I have put this money for that period of 5 years? So ideally, I could have put that money on a fixed deposit earning 7% compounded for that period. So that is opportunity cost lost. So I would expect to be compensated for that 6% or 7%. So you're already at 17%. So then when you look at the individual stock that now you're buying, you're looking at the risk of that industry, their management capacity and capabilities, and maybe you say, okay, above the risk-free rate, I'll add a premium of 3% or 4%. So all of a sudden, you're saying that if I am to invest in equities, I should be getting a return greater than 20% to compensate me from the opportunity lost whilst my money is tied in that stock. Again, this is dividend neutral, saying that there's no dividend that is being paid. If there's dividend that is being paid, then yes, you have periodic cash flows that are coming in. You might revise your required rate coming down. But as we speak, if a counter cannot give you 20% per annum, then you are better off having invested in another security, because you will not have been fully compensated for the risk that you would have taken.
And so the reference rate here is 20%, give or take, is the amount of return you want to be looking out for. And this is really affiliated to the risk affiliated with the underlying companies that you're investing in on the NSE. Reginald, my next question is when we look at the horizon of long-term and short-term, and rather than answering it as we typically answer it, whether in terms of years, I want us to demarcate and sort of create a difference between institutional investors as well as retail investors. And I ask this based on this context. I keep engaging with retail investors and they say they want to put it away for 5 to 7 years. And I know the considerations for you as a retail investor are very different from the considerations for someone such as you if you had assets under management, and we would call you institutional. Because for you, you still have money that's coming in and you're now beginning to look at different asset classes and putting money away. How do you look at the short-term and the long-term horizon if I am a retail investor and not necessarily an institutional investor?
As a retail investor, again, we go back to the beginning. Before you decide whether you want to invest in a stock, whether short-term or long-term, the question is, do you have a portfolio that you have structured that meets your goal? Most of the times, we only leave this element of creating a portfolio to institutional investors, but as an individual, you need to create a portfolio which will determine whether you're going to invest short or long term. So by portfolio, what do I mean? By portfolio, as a retail, as an individual person, your portfolio needs to have, number one, money market or cash in investments. You need to be liquid enough. Your portfolio needs to have fixed income investments. Your portfolio needs to have some element of property, if you are able to invest in property. So your portfolio ideally should also be diversified. So then if you go to your life goals and you say, I have a goal to say, I want to build my own house in 10 years' time. I want to build this house in this certain area. Land will cost me this much. And by the time I'm able to build, maybe starting from 5 years from now, building a house, the cost of the equipment will most probably cost this much. Then you work backwards. What then do I need to invest in, and for how long, and at what risk? So you'll find people saying that I'm short-term investors and they're putting school fees money to try and double it before they pay school fees for the next term. Now that's proper gambling, because you have not done any risk assessment and there's no goal that you are trying to actually achieve. So if I say I'm building that house in 10 years and I need to raise 20 million between now and 10 years, how best do I raise that money in that period of 10 years? Which stocks will pay me enough dividend to maybe cover 30% of what I need to give? And what stocks will give me enough capital gain, or growth stocks, as we normally call them, for me to be able to raise that money? And as you get closer to your target, or you get closer to your goal, again, your portfolio needs to shift. Because as you get closer, you don't want to have a COVID situation and you lose all your money. So as you're getting closer to your goal, let's say 3 years to your goal, you're shifting from maybe a growth stock to more of a dividend paying stock, if you still want to be in stocks. And as you're getting closer, more closer, a year or two, you're actually shifting to fixed income, because now you are thinking of more capital preservation than capital growth. So as individual retail investors, you need to actually build a portfolio based on the goal that you want to achieve, and the timeline of that goal will determine whether you will invest short, long, and the risk that you are able to take.
Reginald, I think I can't ask any other question after that, because what you're telling us, in as much as the stocks are becoming cheaper, do not use the stock market to gamble and sort of look for loose wins. And you really have to do a bit more work to identify whether this is a good time for you to be in stocks, and if so, which stocks, and how are stocks actually aligned to your own financial well-being. I really like that. We have to end it. That's all the time that we have with us today. Thank you, ladies and gentlemen. That was Reginald Kadzutu from Zamara. He's the head of the mass market pension product in that company. What he's told us today is a lot of things. There are many moving parts in as far as the Nairobi Securities Exchange is concerned. Yes, there are companies that would be worth your while, but you have to take some time to first and foremost identify, is now a good time for you to be in stocks? At an individual level, what is your long-term plan and how do stocks play into this? And you also need to do some work to identify what stocks make sense for you and how can you be able to make some money from that. What I keep hearing, and I've heard this whole week, is mind your own business when it comes to investing. Yes, you can listen to other people out there, but the ultimate decision, risk, and return lies solely with you. So you must be more vested in terms of trying to understand what you're getting into and deciding for yourself whether that's the right time. That's it from us here at Markets Today. We wish you an awesome day ahead and see you next time, same time. Good day.